Greetings everyone, this is Patrick from AllQuant. The financial market today looks very different from 20 years ago due to the development of a new product called ETF. So today, let's take a closer look at ETFs. Specifically, we'll look at what are ETFs, the different types out there, what are the advantages of using ETFs, what to look out for when deciding which ones to invest in, and how do you go about buying ETFs. So what are ETFs? Now, ETF is an acronym for Exchange Traded Funds, and it literally means funds that can be traded on an exchange. Before ETFs came along, most retail investors are only able to buy stocks from a stock exchange. In order to diversify, an investor has to buy different individual stocks for his portfolio. Hence, a certain minimum capital is required before enough diversification can be achieved. This is both expensive and inefficient. If an investor wants to diversify outside of stocks, there is no easy way to gain access. Some of these alternatives include bonds, commodities, and futures. With the evolution of the ETF market, the picture looks quite different today. Financial companies are the issuer of ETFs. What they do is they buy stocks directly from the stock exchange and they issue units of the ETF, which represents partial ownership of the underlying basket of stocks. Investors can then buy these units of the ETF directly from the stock exchange. In this way, the investor immediately gains exposure to the basket of stocks without having to buy them individually. Hence, diversification is achieved with a much smaller amount of capital and is also more cost efficient. The issuer is also not restricted to only buying stocks from the stock exchange. They can package other alternative assets from other venues and issue the ETF units into the stock exchange for investors to buy. In this way, the investor can gain access to these alternatives directly from the stock exchange as well. Of course, the issuer charges a management fee for doing all this work. However, the charges are generally reasonable and can also be cheaper than if you were to do it yourself. Because of the flexibility of the ETF structure, there are literally no limits to what the issuers can do. I will not be able to do a comprehensive coverage of the different types of ETFs available, but they are generally classified into a few groups. ETFs are generally split into either active or passive ETFs. Active ETFs are managed just like a mutual fund, where the issuer acts as the fund manager to make active decisions on which securities to hold in the basket. They sometimes engage in market timing as well. Passive ETFs are those where the issuers follow a systematic approach to maintain the basket of securities in a predefined allocation. They may do rebalancing when needed. In general, passive ETFs are cheaper than the active ones. ETFs can also be classified according to the asset classes that the holdings belong to. So we can have stock ETFs, bond ETFs, commodity ETFs, currency ETFs, and so on. They can also be classified according to the geography of the holdings. We can have country ETFs where the holdings are all stocks belonging to one country. We can also have international ETFs where the holdings are spread out across the world. Another way to classify ETFs is whether leverage is employed. Some issuer can structure the ETF such that it gives a leveraged exposure to the underlying index. For example, we can have an ETF that gives a 2 times exposure to the S&P 500. So when the S&P 500 gain 1%, the ETF is expected to gain 2%. There are also inverse ETFs that gives the effect of shorting an index. So if the S&P 500 loses 1%, the inverse ETF is expected to gain 1%. There are also leveraged inverse ETFs as well. What are some advantages of investing in ETFs? By now, you should have realized that the biggest benefit of ETFs is that it allows easy diversification for the masses. It also provides access to other asset classes that otherwise would be out of reach. In recent years, some issuers have also replicated some simple alternative strategies into an ETF structure. Hence, investors can also access these strategies just by buying the ETF. Strategies can include things like smart beta, trend following, risk parity, and so on. Now, because ETFs are traded like stocks, you can buy and sell anytime throughout the trading day. The ETF market is extremely competitive. The issuers are all trying to undercut each other on the fees they charge for the ETFs. This is obviously beneficial for investors. Now, if you are considering to invest in ETFs, here are some things that you need to look out for. I would seldom encourage herding behavior, but in the case of ETFs, I think joining the herd is a sound thing to do. Due diligence still needs to be done, but at least it gives us confidence that the issuer is at least reputable. So a good indication of popularity is the total amount of money or AUM invested in the ETF. The larger the AUM, the more popular. This also has benefits in terms of trading liquidity. The next thing to look out for is the daily trading volume of the ETF. You would want to go for an ETF with greater daily trading volume because it offers better liquidity. This would reduce your trading costs in terms of the bid-ask spread. Next, look at the expense ratio of the ETF. This is the cost of operating the ETF, and it is charged by the issuer. It is usually much lower than 1% for a passive ETF, but for an actively managed ETF, it can go above 1%. While past performance is not a guarantee, it is also important to look at this over a full market cycle to see if the performance is something that you would expect for that particular ETF. And finally, if you're considering a more complex ETF, it is important to look at the term sheet, which tells you how the issuer actually replicates the ETF. Make sure it is what you are looking for before you invest. So how to go about buying ETFs? The first thing you need is a brokerage account, which you should already have if you already own stocks. If not, just open any brokerage account, right? Once the account is open, you can simply look for the ETF on the brokerage platform and buy it just like any other stock. But there is no need to rush into buying. Make sure you do the necessary research as covered earlier. Okay, so to help you in your research, you can refer to the link below for a comprehensive list of all the ETFs available. All right, I hope you have a better understanding of ETFs and how you can go about selecting the right ETFs for yourself. So do smash that like button and subscribe to our channel for similar content. Also, AllQuant conducts courses on investing, so do visit our website for more information. You can find the link below. Thank you for watching, and I'll see you at the next video.